Chaos is coming. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, Biden's disastrous Middle East policy is threatening economic chaos. We're going to take a look at what's going on in the Middle East and why this is going to have such an impact on U.S. consumers at a time when we're seeing in the data they're finally getting ahead of inflation. But the policies being put out by the administration today are threatening to send inflation higher, and you're about to see even worse, send many people to the unemployment line. And it's not just the U.S. economy that's facing a threat right now. As you'll see, it's the entire global economy that's going to be impacted unless things get dealt with swiftly in that area. And right now, there's no signs that anything's going to change. Plus, we have a sponsor for today's show. You might remember Pet Vivo. Well, they're back. And the last time we featured them on the show was December 20th. And after that, their stock rallied 30%. Now, you can find them on the NASDAQ under the symbol PETV, P-E-T-V, and their products, as you'll see later in today's show, are taking off in a big way, and this is setting up the next big move of a 40% upside potential for their stock. Stay tuned because this could be a huge boost for your trading account. You can also check out the pinned comment or description below for more information. Now, let's head over to Bloomberg, where we picked today's story up with the headline, Biden's Middle East policy stalls in messy reality. And this is a big problem for our president right now because he's facing re-election in November. And right now, a lot of people do not like his policy that's going on in the Middle East. The problem is many Americans do not understand how this is going to impact their day-to-day life. Even worse, how it's going to impact the labor market. And we continue to hear from political elites, including the White House, how strong the U.S. labor market is. But if things don't get resolved in the Middle East, as you're about to see, the labor market here in the U.S. is going to pay the ultimate price. The U.S. military is back in the Middle East, and well, it's not going very well. American-led airstrikes against Houthi militants who have been causing havoc in the Red Sea haven't stopped the Yemen-based group from escalating attacks on ships. If anything, the situation has got worse. Are they stopping the Houthis? Well, no. Are they going to continue? Well, yes. This according to President Joe Biden. The question here is, Mr. President, why isn't this being dealt with swiftly? Because what you don't see here is the impact on the U.S. economy. And the challenge here is we know the data shows up with a lag. So what starts to happen between now and the next several months is going to have a major impact as we go into the November elections. Now, let's talk about what this means from the shipping side here. Let's head over where we talked about Metre now. They're warning of a significant disruptions to global shipping network as the attacks persist. Now, this from the CEO, while we hope for a sustainable resolution in the near future, and we do all we can contribute towards it, we do encourage customers to prepare for complications in the area to persist and for there to be significant disruptions to the global network. So what's going on here just isn't going to impact the U.S. economy, which I'll show you here in a little bit, but it's impacting the global economy. And the challenge here, at a time when we're seeing the entire world slow down in terms of its economic production, we need anything to keep it going. This threatens to be the push that shoves it further to the downside. The CEO of Metre goes on to say, so for this, it will mean longer transit times and probably disruptions in the supply chain for a few months at least, hopefully shorter, but it could also be longer because it's so unpredictable in terms of they just don't know how long this is going to go on, of how this situation is actually developing. Of course, the challenge here is you think about it, if transit times are going to be longer, well, that means products are going to take a lot longer to get to their final destination. The other issue is the cost to ship is going to go up. And earlier this week, Stifel shipping analyst Ben Nolan told clients that the Red Sea issues are getting worse, not better. This is not a good sign for the Biden administration, who needs to get this issue knocked out and fast, because the knock-on effects of the Red Sea disruptions have pushed companies to rent more vessels, thus reducing capacity, which has increased shipping rates in recent weeks. Now, you think about this from an inflationary standpoint. What does the Biden administration desperately need a victory over? Along with the Federal Reserve, they need to bring inflation down well ahead of the elections so they can say, look, American consumers, American voters, look what we did. We maintained the labor market. We maintained your wages, and we brought inflation down. So hope is here. put us back in the office for another 4 years. But here's the challenge they face, as you can see on this chart. Shipping prices now heading back vertical like we did see during the pandemic. This, again, not a good sign for the Biden administration at all. And if we talk about how this back feeds into inflation here, we can look at the consumer price index in blue against the import price index, this shown in red, for all commodities, both now on a year-over-year rate of change. And what's important to understand here is the import price index leads the consumer price index. And this makes perfect sense because as things are imported, we see them in the import price index, and then later, as they get to the consumer and are sold, we see them in the consumer price index. So things that happen today that cause import prices to rise on future imports over the next several months will backfeed into the consumer price index. Well, you can only imagine by the time we get to the election, that could put upward pressure on the CPI, and in turn keeps the Fed at rates that are elevated. And we know, again, the other big win for the Biden administration here is if the Fed could be cutting rates going to the election, they could say, look what we did for you. And here's the problem right now. We're seeing import prices rise, leading potentially a resurgence in the consumer price index in the months to come. And as long as the Israel-Hamas war rages, the Houthis insist they will maintain their campaign against shipping, so far giving us an indication they're not going away anytime soon. And critics say that anyone who followed the Houthis' hardened resistance to years of Saudi military airstrikes and their continued support from Iran, which is a big problem, should have known the U.S. and U.K. attacks on the group would have little impact. And yet that doesn't stop us from trying. The issue here is this needs to be put out and put out fast. If there's any hope here to get the inflation numbers down ahead of the election, the Biden administration needs to be highly decisive here. Challenge is, they're really not. And back home, where Biden faces a tough re-election battle, while most Democratic and Republican lawmakers back the administration's pro-Israel policy, polls show substantial public disapproval of his handling the conflict in Gaza, especially among younger voters. Of course, those disapprovals will get into the election time. That will be a huge problem for our incumbent president. And yet, he does strike back now, but will it be enough? I'm not sure. As U.S. says, airstrikes hit Houthi anti-ship missiles before launch, and guess what? You're going to see a lot more headlines like this as the media suggests that we are being decisive here. The problem is we will not have won until ships are passing back through the Red Sea. Doesn't look like that's happening anytime soon because roughly 12% of global trade flowed through the Red Sea before the Houthis began targeting commercial ships. And the attacks were a response to Israel's bombardment of the Gaza Strip, which followed the October 7th infiltration and attack on Israel by Hamas militants. And here's the issue now. If this doesn't get dealt with quickly, the problem is U.S. consumers cannot afford higher prices right now. And that is a challenge because when you're in a slowing economy, as we've talked about in previous shows, wage growth comes down, hours work slows down, and if you see a spike in prices, well, the issue is consumers just can't afford it. And that actually leads to much bigger problems, as we can see on the next slide. Now, as we look at import price index, this is still shown in red. Now we're going to overlay total compensation in terms of average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. Because if you do see a price increase in the economy, but wages are growing, well, then you know that consumers can absorb it. Now, the challenge here is what if prices rise at a point where maybe there's evidence that consumers can't afford it? What does that mean? Well, nothing good for the Biden administration at all. And here you can see, looking back in history, we can look in the early 90s, we saw a spike in import prices at a time when total compensation, shown in blue, was decelerating. And what did that lead to? A further deceleration in compensation. And again, you think about what the Biden administration needs here, a huge victory to say, look, we kept your wages up. We brought inflation down. The only issue here is why isn't this being dealt with faster? And here you can see again, as we look into the 1990s, around 1994, when yours truly graduated high school, we had a very soft recession. What happened? Import prices went up. Well, total compensation went down. Again, consumers couldn't afford it. So I want you to be thinking they spent less. And here, as we go into the dot-com bubble, import prices spiked. But notice that wage growth didn't keep up with it at all. That led to a deceleration. In fact, a collapse in total compensation. Same thing happened in the global financial crisis. And now we're we're starting to see the seeds of it now. So the question then becomes is, why did, of course, total compensation go down? Because this is the one big thing that neither the Fed nor the Biden administration wants to see, and that's the labor market go. And sure enough, the evidence is very clear. If prices go up and people can't afford them, well, they spend less, and that means layoffs show up. And here we have continued claims shown in green. And what you can note is that each and every instance where we saw a rise in import prices and a deceleration in total compensation, there was continued claims went up. You see them here in the 1994 through 1996. You see it again happening during the dot-com bubble, again during the global financial crisis, and now just at a time where we're hearing signs that people are suggesting that, yes, people are going to get back into the labor market. Well, if we see a price increase, they're not. And that is a big issue here, because this threatens now to unravel the U.S. labor market. At the same time, it's threatened to destabilize the Middle East. These would not be good in the months to come if you're facing re-election. Here we can see the UAE warns the U.S. time is running out to avoid a wider Mideast crisis. And yes, this will have bigger impacts, because if things go in the Middle East, well, what does that mean potentially? Higher energy prices, and that is not something you want when the global economy is slowing. We need a humanitarian ceasefire now, and we can't wait another 100 days. This is the UAE ambassador to the United Nations said in an online interview. The risks are high. The war in Gaza is very clearly an open wound. It's destabilizing the region, she said, adding that the U.S. could play a critical role in easing the tensions, making us wonder why we're not doing more here. And this then comes back to crude oil and inflation, because as we note that we've seen these product bills in gasoline and distillates over the last few weeks, and this Thursday we'll get some more evidence of where that's headed. Well, if we see lower energy prices, this is a good thing for U.S. consumers. But if we see destabilization in Middle East, well, we can likely expect that means further issues with supply, higher prices, and lo and behold, that is not a good sign, because if import prices start to rise, and then you see crude oil prices now shown on a year-over-year rate of change, that is WTI in red, well, that would put even massive upward pressure on import prices, and that would lead to, as you can see historically, and we talked about, more Americans on unemployment. Talk about the wrong move at the wrong time, making what's going on here in the Red Sea very critical for the Biden administration to deal with, and quickly. And here we can see, of course, if WTI goes up, we know with a lag, it feeds right into gas prices, and that feeds right into the consumer price index. And if you think about how dangerous this is for the U.S. economy, if we see inflation kick back up here and consumers don't have the money to keep pace with it, which we know they don't, well, that means more people on the unemployment line, and more likely than not, we face a recession by the time the elections happen, if not an all-out financial crisis. And we look through history, we know the probabilities of an existing president, sitting president, getting reelected in that case, well, it's next to zero. And the problem here, of course, as we look around the world, the hope is to bring energy prices down to give people a little more money to keep the economy going. Now let's head over to the UK, where we get a good picture of this. As we see, UK homes could see the steepest fall in energy bills since the summer. And this is exactly what we would need here. If we can bring energy prices down, that frees up some spending. That means consumers can go out and keep the economy running, but it may not be enough if we see further destabilization in the Middle East. And prices are much lower than the peak seen last winter, when the government stepped up to subsidize bills, but remain more than 50% above historic levels, keeping a strain on consumers hit by a cost of living crisis, because most UK government support ended, well, last year. And here we can see in December, the customer debt by the autumn of 2023 had ballooned to $2.9 billion. And separately, here we come back to the Middle East as we look at the conflict there, and the shipping disruptions that followed have so far muted impact on the market. But if that changes in any material way to the energy sector, we'll watch out. And of course, we then go over to Korea here as we look at South Korea's data, and we can already see it's having an impact on the global economy right now. As Korea's early trade data indicates a patchy export recovery as growth in exports slows, demand in China, as you're about to see, well, it remains very weak. And the value of shipments adjusted for working day differences increased 2.2% from a year earlier in the first 20 days of January. Now, if we look at this and compare it to the U.S. Consumer Price Index, we can see that that means demand is going down because inflation is still running higher here than what we know from these export data. That is not a good sign of increasing demand in the global economy. Headline exports fell 1%, not much, but look at this. Overall imports declined by 18.2%. Talking about a lack of demand now internally from South Korea. Again, we look for signs the global economy is slowing. You put this trade issue, of course, with the Red Sea in play here. You drive prices up. U.S. consumers spend less. That means new orders go down. And then, of course, it back falls to countries like China, South Korea. They start laying off. And the next thing you know, the entire world is in the midst of a massive synchronized recession. And the economic woes in China are among headwinds affecting South Korea's trade, a raft of major elections. Here we go, back to the elections across the world will contribute to geopolitical uncertainties for commerce, as well as we note that when voters are not feeling confident, if they're feeling uncertain, they tend not to spend. They tend to then save and pay off in their debt, and that's not what you need in a debt-based economy to keep it booming. But one thing that could be a big boom to your trading account, that's our sponsor for today's show, Pet Vivo. Again, you can find them on the NASDAQ under the symbol PETV. Everything's in the description and the pinned comment below. Let's talk about what's going on with this company, because as I mentioned in the beginning, the last time we featured them on the show was December 20th. The following day, had you bought it market open, the stock has gone up 30% from its recent peak since we featured it on the show. As you're about to see, their products are gaining traction in a big way. The more they sell, the more revenue, the more profits. That all comes back to the stock price of why we think there's another 40% move on the horizon. And here you can see that we're not the only ones that see that here. An analyst is saying that they believe the target for Pet Vivo stock is much higher. Well, they're looking at a potential 466% return. That's well above where we're looking at for an initial move, but this company's products could take this thing to the stratosphere. And here we can see is they have achieved distribution milestones surpassing 4,500 syringes of Spring in 2023. And this is a wonderful product that's achieved a significant milestone with its osteocushion technology has now been distributed to veterinarians in this last year. And thanks to support of veterinarians throughout the United States, Spring has experienced strong momentum this year, driven by the beneficial outcomes experienced by thousands of animals injected with this life-changing product. Of course, we know people will spend massive amounts of money on their pets, and of course, that comes back to Pet Vivo's product here of Spring and why there's going to be demand, because if it works for one person's pet, well, they're going to tell a bunch of their friends, and of course, the veterinarians are also going to further recommend it, and that means demand and the stock price could go to the moon. And if we see enthusiasm for Spring is higher than ever, making this biggest year yet for Spring distribution. The distribution of syringes is an increase in excess of 60% from the previous year. And of course, that has been driven by the release of a recent Spring clinical study showing such as cranial cruciate disease study performed by Ethos Veterinary Health, as well as numerous presentations and references at industry trade shows by reputable key opinion leaders in this space. And we anticipate the enthusiasm will magnify into the new year with the release of additional clinical studies and further exposure. And here you can see they've also announced distribution agreement with Covetrus North America. And this is a company that has entered a definitive distribution agreement with Pet Vivo, and Covetrus will inventory, market, and promote their veterinary medical device Spring with osteocushion technology throughout the United States. So we're going to see even further, more people have access to this product, this technology, and that means sales could go just straight up. Along with their stock prices, let's go back to the last time in December. Here we featured it right here on the show. And if you bought at market open the next day up to the recent peak, you had a nice 30% gain. And we think this is even the beginning. You can see a beautiful bottoming pattern here looking to break out. Today, the price of the stock came down and buyers jumped in to support. Why did they do that? Because here we can look at the volume profile and we can see this is where buyers are at. They're coming in supporting it. We first brought it to you way back here. Next move is 40% upwards to the next supply zone, and we think that could be a huge boost to your trading account in a major way. So again, before you do anything, be sure to check out Pet Vivo, and as always, you're under no obligation to purchase any stock of any company we feature on the show. But I think when you do your research, you'll see that with Pet Vivo, again, on the NASDAQ under PETV, there's a massive opportunity. With that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.